my name is Thomas Reagan. Today I wanted to speak to you guys about supply and demand in the property market. Now, it may sound obvious when I'm saying it like this, but obviously the less properties there are for sale, the higher it will push the prices. For example, if you go and look into a marketplace and there's 20, 30 properties that are of comparable size and bedrooms and bathrooms and all that sort of thing in one suburb, then it's going to be beneficial for you, depending on how big the suburb is, obviously, beneficial for you as the buyer because you'll be able to negotiate a good deal. And that is dependent on actually as well how many people are also looking for property. Now, let's refine on that a bit more. So supply and demand, it doesn't matter if the supply is high in an area of properties. What really matters is the supply more than the demand? Because that's what really matters. Because if there's not enough people, if there's more properties for sale than people can buy, that will drive the prices down. And if there are less properties for sale, say if there's only that same market that had 20 properties for sale that were comparable in one suburb versus you go into the same suburb a year later and there's only 1 or 2 properties that are comparable for sale and there's double the amount of people looking for properties, what is going to happen with those 1 or 2 properties is it's going to drive up the price. And supply and demand, if you don't know already, supply and demand is one of the biggest contributors of growth in the property market. Okay, so there's other levers in the property market which I won't get too much into today, but one of them, which is a huge one, is the interest rate or the cost of borrowing or the ability to service a loan, and that is driven by the banks, and the banks' interest rates are driven by the RBA, and then there's a few other factors which affect serviceability, and that is the policy that the banks are operating under. Now, for example, if a person was going to borrow money from the bank and the bank was one day they said they do consider overtime pay within their policy, therefore you make $100,000 base income and you make $50,000 overtime pay, then that means with your overtime pay considered within the bank's policy, you can service a bigger loan. Okay, now if, for example, the bank's policy changed and they said we do not accept overtime pay in servicing calculations, that would reduce your borrowing capacity. Now you could imagine if the policymakers that regulate the banks changed the policy overnight, that would actually have a negative impact on a certain property price range for anyone and a large majority of the marketplace which are trying to get a loan for that property and they receive overtime pay. Now, policy, and then again I said RBA, the interest rate affects the servicing. So when basically what the RBA is trying to do is the RBA is trying to through the interest rate, the RBA interest rate, they're trying to control inflation in a positive figure, and that positive figure is between 2 and 3%. Any higher than that and the economy starts to get a little bit volatile, and anything below that, the economy sort of starts grinding to a halt. Okay, so the RBA is trying to stimulate the economy by either raising or increasing the interest rates. Now, if there is high inflation, and this isn't as simple as I'm putting it, but if there's high inflation, that is a bad thing for the economy. It is eventually going to, if high inflation goes on and on and on, it is eventually going to be the cause of the collapse of the economy. And generally, if it's just simply, without taking too much other considerations in it to illustrate the point, what the RBA can do to keep the economy stable is they raise the RBA interest rates, and that affects the whole economy. It affects banks, it affects governments, and it trickles down to the end consumer being you. And the way that will trickle down is the RBA will increase their rates, and the banks are paying these rates. That's their overhead, and then it will cause the banks to increase their rates as well, which will affect you as the end consumer. And because the banks are governed by policy and regulation, that will cause your borrowing capacity to go down. Now, I don't really know why I started talking about that, but this video has gone a bit off track, but hopefully it was insightful for you if you're looking to invest in property. See you guys next time. Bye.